Welcome to Talk Tickers. Our mission, as always, is to cut through the earnings call noise and get straight to the insights that, well, actually matter. Today, we're diving deep into BAE Systems' H1 2025 earnings call. On the surface, the numbers looked incredibly strong, really solid, yet the market had this surprisingly cautious reaction. So we're going to unravel that puzzle for you. We'll explore how this, global defense giant balances its massive, multi-decade strategic programs with some really agile, cutting-edge innovation, and what that tension, that balance truly tells us about where the industry might be heading.
That's right. We'll unpack their financial performance, look at the strategic shifts, and what management believes is really driving their momentum. All of this happening against a backdrop of, significantly elevated global defense spending. And importantly, we'll highlight why the market reacted the way it did despite those really robust numbers, maybe what that signals for investor sentiment in this whole sector.
Okay, let's dive straight into those headline numbers then. First half of 2025, BAE reported pretty impressive sales, $14.62 billion. That's an 11% jump year over year. Underlying EBIT, earnings before interest and taxes, also saw strong growth, up 13% to $1.55 billion, which gives them a healthy 10.6% return on sales.
Yeah, pretty solid.
And underlying EPS, earnings per share, climbed 12% to 34.7p. Orders were strong too, $13.2 billion, adding to this huge backlog of $75.4 billion. They even bumped up the interim dividend by 9% to 13.5p. So good news all around, you'd think.
Yeah, on the surface, those are, without question, strong figures, really strong. However, what immediately caught the market's eye was this interesting dynamic just beneath the surface. Despite that stellar top-line performance, and they even upgraded their full-year guidance, investor attention seemed drawn to a couple of specific metrics, leading to that cautious initial reaction you mentioned. Free cash flow, for instance, that showed an outflow of $368 million. Yeah, and that's a figure investors watch really closely, right? It's the cash left after running the business and investing. And seeing an outflow contrasted sharply with an inflow in the first half of the previous year. Net debt also ticked up by about £500 million, reaching £7.3 billion.
Okay, so that initial market caution, especially around the free cash flow, seems like the key point we need to dig into. What did management actually say about that outflow? And, what does it reveal about how investors maybe perceive these defense contractors with really long production cycles?
Management was very clear on this point. They said the FCF outflow was largely down to expected seasonality. Basically, customer advances they'd received before were paid out to their supply chain during the first half, but they didn't receive significant new material advances in that same period to offset it.
Ah, okay, so a timing thing.
Exactly. They stressed they remained very confident, and they reiterated their full-year FCF guidance higher than $1.1 billion, excluding any potential new advances. So it's presented as a timing issue, definitely not a structural one. And it's really critical for investors to get that distinction in this industry.
Got it. Timing, not structure.
And that confidence wasn't just limited to cash flow. It extended to their full-year guidance update. They actually raised sales growth expectations. It was 7-9%. Now it's 8-10% year over year. And underlying operating profit guidance also went up from 8-10% to 9-11%.
So better sales, better profit outlook.
Right. But, and this is what's genuinely fascinating here, their EPS growth guidance, earnings per share, stayed unchanged at 8-10%.
Despite the stronger sales and profit. How does that work?
Well, it wasn't a performance issue at all, apparently. It was more mechanical, as they put. Two things. First, fewer shares are being repurchased because the share price is higher. Simple math there. Second, there's a slightly increased tax rate in France that's impacting the profits from their MBDA stake. And those two factors together basically canceled out the improved sales and EBIT outlook when it comes to calculating the EPS guidance.
Huh. That's a really crucial nuance. Thanks for clarifying that. It's easy to miss. So with those financial dynamics kind of laid out, let's pivot now to the strategic vision that's driving BAE. Management kept highlighting their value compounding model. It sounds impressive, suggests long-term growth building on itself. How exactly does that work? What's underpinning this exceptional visibility they keep talking about?
Yeah, it's definitely more than just a buzzword for them. It seems central to their long-term stability plan. They emphasize this massive combined confirmed order backlog, plus their incumbent positions, approaching $260 billion.
$260 billion.
Yeah. To put that in perspective, it's more than 8 times their annual sales.
Wow. That's practically guaranteeing work for nearly a decade, whatever happens. Most companies would kill for that kind of foresight.
It provides truly exceptional visibility. for their growth outlook. Absolutely.
So how do they achieve that? How does the compounding actually happen?
Well, it comes from this dual-pronged approach they have. And this is where the compounding really comes into play. On one hand, they're capitalizing on shorter cycle, high growth areas. Things like drones, munitions, stuff that provides immediate revenue and lets them iterate quickly.
Okay, the fat stuff.
Right. But simultaneously, they're strengthening their position in these critical multi-decades programs. We're talking things like GTP, the Global Combat Air Program, which is mapping out the future of air defense for the UK, Italy, Japan, and the SSN Orca submarines, the UK's next-gen nuclear attack sub. Huge long-term projects. These massive programs won't even hit full production until like the mid-2030s or even later.
That makes sense. Balancing the short and the very long term. And speaking of the environment they're operating in, let's talk about those macro tailwinds. The global defense spending picture is definitely strengthening. I mean, in a way we probably haven't seen for decades. You've got the UK aiming for 2.5% of GDP on defense by 2027, maybe even 5% for national security by 2035. The U.S. defense budget request, $961 billion, including reconciliation funds. That's like a 13% jump over the prior year.
Huge.
And Japan planning to double defense spending by 2027. Saudi Arabia expecting a 5% increase in its military budget next year. It's everywhere.
These geopolitical shifts are definitely providing a significant demand backdrop, no question. And BAE Systems seems strategically aligned with these priorities across multiple key regions. In the U.S., for example, they look well positioned for this Golden Dome concept.
Golden Dome.
Yeah, it's a strategic idea focused on integrating national security space, missile defense, munitions, counter-drone tech, all for homeland defense. And BAE's already secured some significant awards there for resilient missile warning and tracking satellites and the Forged C2 program for modernizing ground systems.
That's interesting. And you mentioned drones and counter drones. I was really intrigued by their innovation there, especially what's coming out of Falcon Works. Going from an idea to actually live firing a guided munition from a drone to shoot down another drone in just 4 months. For the U.S. Marines, that seems incredibly fast for this industry.
It is notable that speed is certainly turning heads.
What does that kind of rapid prototyping mean practically? And how do they plan to scale that agility? Is it just a one-off or...
Well, the core idea behind it, especially for counter-drone, is achieving what they call cost symmetry.
Meaning?
Meaning, instead of using, say, a multi-million-dollar missile to take down a relatively cheap drone, which is economically unsustainable.
Right, bad math.
Exactly. They're leveraging their existing APKWS technology. That's the system that turns dumb rockets into smart precision ones, and combining it with expertise from Malloy Aeronautics, the heavy-lift drone specialists they acquired.
Yeah.
This lets them offer, as they put it, combat-ready capabilities for a fraction of the cost. It makes countering drone swarms actually viable economically, and that's a potential game changer.
Oh, okay. That makes a lot of sense. Cheaper ways to counter cheap threats.
Precisely. And moving across the Atlantic, on the European front, they're deeply embedded in the whole rearmament effort that's underway. The Eurofighter Typhoon is still a critical asset for many air forces, and BAE is investing now to potentially double its production rate from current levels.
Double?
Yeah, driven by clear demand signals and that recent agreement, the MOU, with Turkey. Plus, their stake in MBDA, the Missile Systems Group, is another key growth driver. MBDA itself is committing almost 2.5 billion euros over 5 years just to scale up capacity to meet this surging demand for complex weapons. Yeah. It's a huge continent-wide effort, and BAE is right in the middle of it.
Okay, we've covered the big picture, the strategy, the tailwinds. Let's zoom in a bit now. Where did those impressive sales increases actually come from? Can we break down the performance across their key business segments?
Absolutely. If we shift to segmental performance, platforms and services, or P&S, they really led the way in the first half. Sales there were up a significant 21%. That was largely driven by strong demand in U.S. combat vehicle programs, tanks, armored vehicles, and also really strong growth in their Swedish businesses, Hägglunds and Bofors. They're doing very well.
Okay, P&S leading the charge. What about air?
The air sector also saw solid growth. That was fueled by activities around FC-AT Tempest, the future fighter program. And of course, that booming Falcon Works drone portfolio we were just talking about.
Right.
Now, it's worth noting, while P&S saw strong margins in H1, management does expect the full-year margins to be slightly lower.
Any reason why?
Again, timing. They clarified it's mainly due to the timing of R&D expenses, which seem weighted towards the second half of the year. So, not a worry about the overall trajectory. In fact, they mentioned Hägglunds and Bofors are actually performing ahead of their initial production outlooks.
Good to hear.
And Maritime profitability was slightly down in H1 as well, but again, attributed to milestone timing on big projects, nothing structural. It's expected to return to its typical 7-9% range later on. So, yes, some temporary fluctuations in profitability, but the underlying business drivers seem sound across the board.
Okay, so pulling it all together, what does this all mean for you, the listener, trying to make sense of BAE? We have strong operational delivery, upgraded guidance on sales and profit, but the market's initial reaction was cautious, focused on that H1 cash flow outflow and maybe a perceived, normalization of orders compared to a really blockbuster previous year. It sounds like investors were maybe a bit too fixated on those short-term numbers.
That's likely a fair assessment. It really highlights the market's sensitivity sometimes to near-term cash flow movements and the phasing of new orders. Even when the underlying growth story and the long-term outlook look fundamentally bullish, these short-term blips can grab attention. Management, for their part, maintains that the multi-year growth path for BAE Systems remains firmly intact, driven by scaling up these big platforms, deepening their exposure in the U.S. and with allies, and compounding value through, selective M&A and building out capacity.
And it's not just them saying it, right?
No, exactly. You had recent credit rating upgrades from both Fitch and S&P, and Moody's upgraded their outlook too. That provides external validation of the company's financial health and its long-term prospects. So ultimately, BAE Systems is navigating this complex but definitely opportunity-rich global defense environment. It's a balancing act between those huge long-term strategic programs and the need for agile, high-growth innovation.
All right. It's time for our This Is Not Financial Advice segment. Purely hypothetical, maybe outrageous, but plausible ideas for thought. Given BAE Systems' clear leadership and these aggressive investments, especially in drones and counter-drones through Falcon Works, here's a mind experiment, something for the truly adventurous, perhaps.
Okay, let's hear it.
Instead of focusing on BAE itself, what if you looked further down the chain?
How do you mean?
Well, think about how BAE's rapid development cycles, particularly Falcon Works, cranking things out in months, how that could create these extreme, maybe unpredictable demand surges or even technical dead ends for smaller, specialized suppliers in their ecosystem.
Ah, okay. So not betting on BAE directly.
Right. But betting on the volatility and maybe the disruption their accelerated innovation creates within that whole drone and counter-drone market, you're looking at the ripple effects.
Interesting. So it's a bet on the unforeseen consequences, the second-order effects of this rapid defense tech advancement. You're looking one step removed at the micro-level impacts caused by a macro player like BAE, accelerating the pace.
Exactly. It makes you wonder, doesn't it? Which niche suppliers, maybe sensors, propulsion, specific software could be disproportionately affected positively or negatively by BAE's next big breakthrough or sudden shift in requirements?
Yeah, anticipating those knock-on effects of innovation, that's definitely a different angle. A thought experiment, as you say.
A thought experiment indeed. Okay, and that wraps up our deep dive into BAE Systems' H1 2025 earnings call. We've seen a company showing robust financial performance, definite strategic foresight in this rapidly changing geopolitical landscape, and what looks like a clear path for sustained growth, even if the market had a few near-term jitters.
Yeah, they're clearly positioning themselves for a multi-year growth cycle. It's driven by both those traditional big defense programs and these cutting-edge innovations, especially in areas like uncrewed systems. That huge order backlog and the upgraded guidance really underscore management's confidence in their ability to deliver on that long-term vision.
Well, thank you for joining us for this Talk Tickers deep dive. We hope this gave you a clearer picture of BAE Systems' performance and outlook. We always appreciate hearing from you. What stood out to you in this analysis? Any thoughts or questions? We'd love to hear them.